Welcome to Dollar Donkey's latest offering, how value investors can profit from geopolitical risks. Let's dive in. Geopolitical risks, such as trade wars, political instability, regional conflicts and shifts in global power, are typically viewed as threats to economic stability. For many investors, these risks trigger fear, causing market fluctuations and unpredictable stock performance. However, for value investors, geopolitical risks can also present lucrative opportunities. By understanding how to navigate these risks, value investors can profit by acquiring undervalued stocks during times of uncertainty. This video explores how value investors can profit from geopolitical risks with a focus on key value investing strategies. We'll define relevant terminology and illustrate these strategies with real-world case studies, demonstrating how savvy investors can turn geopolitical turbulence into profitable opportunities. Understanding geopolitical risks and value investing. Geopolitical risk refers to the uncertainty and potential financial instability caused by political, economic, and social events on the global stage. These risks can stem from factors such as government policies, international conflicts, sanctions, and changes in the political landscape of major economies. Value investing, on the other hand, is an investment strategy that involves buying stocks that appear to be undervalued based on fundamental analysis. The goal is to identify companies that are selling for less than their intrinsic value, the true value of the company, and profit when the market eventually recognizes the company's worth. The strategy relies on key metrics such as PE ratio, price to earnings ratio, a ratio used to value a company by comparing its current share price to its earnings per share, EPS. PB ratio, price to book ratio, a ratio that compares a company's market value to its book value. Free cash flow, FCF, the cash a company generates after accounting for capital expenditures used to assess financial health. Discounted cash flow, DCF, a method used to estimate the value of an investment based on its expected future cash flows. When geopolitical risks emerge, they often drive down stock prices across various sectors, making it easier for value investors to find attractive investment opportunities. The ability to assess whether these risks are temporary or systemic is essential to profiting from such situations. Case Study 1. The 2018 US-China Trade War. In 2018, the US and China engaged in a heated trade war, imposing tariffs on each other's goods. The trade conflict sparked fears of a global recession, sending shockwaves through the markets, particularly affecting industries reliant on international trade and manufacturing. For value investors, this geopolitical risk presented a unique opportunity. Companies with strong fundamentals but exposure to trade tariffs became undervalued, offering significant upside potential once the dust settled. Example: Apple Inc., AAPL. Apple was one of the companies most affected by the US-China trade war, as the majority of its manufacturing operations are based in China. In 2018, stock prices for Apple fell sharply due to concerns that tariffs on Chinese goods would reduce profit margins. However, value investors using a fundamental approach saw that the company was still generating significant free cash flow, FCF, and maintained a strong brand presence globally. PE ratio. Despite the geopolitical uncertainty, Apple's PE ratio remained relatively low compared to industry peers, signaling potential undervaluation. FCF, Apple's consistent and growing free cash flow, demonstrated its ability to weather the storm and reinvest in its business, positioning it well for long-term growth once the trade war ended. Discounted cash flow, DCF. Using the DCF method, value investors found that Apple's intrinsic value was higher than its market price, signaling a potential buying opportunity. By analyzing the company's fundamentals, value investors saw that the temporary risks from the trade war did not change the long-term prospects of Apple, which continued to generate strong revenue and profit margins. As expected, once the trade war tensions started to ease, Apple's stock rebounded, rewarding those who took advantage of the undervaluation during the crisis. Case Study 2. The Brexit referendum and UK-based companies. In 2016, the United Kingdom voted to leave the European Union, a decision that sparked considerable uncertainty in both the UK and global financial markets. The Brexit referendum created volatility, especially for UK-based companies with significant exposure to the EU market. However, for value investors, Brexit created an opportunity to invest in undervalued UK stocks, especially those with strong fundamentals, but facing temporary pressure due to the uncertainty surrounding the exit process. Example, Vodafone Group plc, VOD. Vodafone, a multinational telecommunications company based in the UK, saw its stock price drop dramatically following the Brexit vote. Investors feared that the country's departure from the EU would lead to reduced market access, higher operating costs, and regulatory challenges for companies like Vodafone. Despite these risks, value investors recognized that Vodafone had a strong global footprint, including operations in emerging markets, and was still generating strong cash flows. PE ratio, Vodafone's PE ratio was lower than its historical average, suggesting that the stock was undervalued relative to its earnings potential. Free cash flow. The company maintained a robust free cash flow, giving it the financial flexibility to invest in its operations and weather short-term disruptions caused by Brexit. PB ratio. The company's PB ratio was also appealing, suggesting that the market was undervaluing its assets despite the geopolitical risk. Value investors who took advantage of this undervaluation during Brexit benefited when the stock rebounded post-referendum, once the market began to stabilize and the company's long-term prospects became clearer. Case Study 3. The Middle East tensions and oil prices. The Middle East is often a hotbed for geopolitical risk, with political instability and regional conflicts frequently affecting global oil markets. Geopolitical risks in the region, such as the ongoing tensions between the United States and Iran, often cause fluctuations in oil prices and affect the profitability of oil and energy companies. For value investors, these types of geopolitical risks can create opportunities to invest in energy stocks when prices fall due to market panic. Example: ExxonMobil. ExxonMobil, one of the largest publicly traded oil companies, was hit hard during periods of geopolitical instability in the Middle East, especially when oil prices dropped. The volatility created by conflicts in the region, combined with falling demand for oil during the COVID-19 pandemic, led to a temporary drop in Exxon's stock price. Despite the geopolitical risks affecting the oil market, ExxonMobil's fundamentals remained strong. PE ratio. Exxon's PE ratio was lower than many of its competitors, indicating that it was undervalued despite the external pressures from geopolitical risks. Free cash flow. Exxon continued to generate strong free cash flow, enabling it to maintain its dividend payments and invest in long-term projects even during volatile periods. Discounted cash flow, a DCF analysis, revealed that ExxonMobil's intrinsic value was much higher than its market price, showing potential for future growth once the geopolitical tensions subsided. Value investors who took a long-term approach to ExxonMobil during periods of geopolitical instability were rewarded when oil prices stabilized and the company's stock price began to recover. How value investors can navigate geopolitical risks. For value investors, profiting from geopolitical risks requires a strategic and disciplined approach. Here are several key steps to consider. Focus on fundamentals. In times of geopolitical uncertainty, it's easy to get caught up in market panic. Value investors should focus on companies with strong fundamentals such as robust cash flow, low debt, and consistent earnings growth, regardless of short-term market fluctuations. Look for undervaluation. Geopolitical risks often drive down stock prices, creating opportunities to buy undervalued companies. Use metrics like the PE ratio, PB ratio, and DCF analysis to assess whether a stock is trading below its intrinsic value. Evaluate the long-term impact. It's crucial to assess whether the geopolitical risk will have a lasting impact on a company's business model or if it's a temporary event. Companies with diversified operations, strong market positions and resilient business models are more likely to weather geopolitical storms and recover over time. Be patient. Value investing requires patience. The market may take time to recognize the intrinsic value of undervalued stocks. But by holding through periods of uncertainty, investors can profit when the market eventually corrects itself. Diversify. While geopolitical risks can present opportunities, they also come with uncertainties. Diversifying across sectors and regions can help mitigate risk while still allowing investors to take advantage of undervalued stocks. Conclusion. Geopolitical risks can create significant volatility in the markets, but for value investors, these risks often provide profitable opportunities. By focusing on strong fundamentals, evaluating the long-term impact of geopolitical events, and using key value investing metrics, investors can identify undervalued stocks that stand to benefit when market sentiment shifts. The case studies of Apple, Vodafone, and ExxonMobil demonstrate how geopolitical events can lead to market overreaction, creating opportunities for value investors to acquire high-quality assets at discounted prices. By employing a disciplined, patient approach, value investors can profit from geopolitical risks and unlock long-term wealth. Thank you for watching. If you found this video helpful, please like, share, and subscribe for more insights on value investing and market strategies.